There we go. Good afternoon, everyone. We're going to give everyone a couple minutes to get logged in. We know it's about 1:01, so we'll give it about another 60 seconds. Give everybody a chance to get on for our fantastic webinar on DSCR loans.
Fantastic.
Hope everybody's having a wonderful Thursday. It's beautiful weather here in the Northeast. John Geminard, our new head of sales, is normally the one that hosts these webinars, but they're on their way out to the National Originator Connect show, so you're stuck with yours truly. But we'll go ahead and get started. My name is Ben Scribner. I'm the regional sales manager for the Northeast here for Angel Oak Mortgage Solutions. We're going to go cover DSCR and short term today, so we appreciate everyone's attendance and a big thing, guys, is the interactive piece. Please questions, fire them away. That actually makes our job easier when you guys express any questions that you guys have, scenarios, things like that. Because if you have that question, I guarantee you someone else on this webinar has the same question. So please hit that chat box and let us know if there's anything out there that you have questions on the DSCR program or process or anything under the sun. But obviously I want to introduce my two panelists as well, Gary Martinek and Denise Maccone. Oh, I said Dennis. My apologies. We'll start north. I'm actually just north of Philadelphia, so we'll start with Denise. Denise is in New Jersey. If you want to give a couple about yourself.
Absolutely. Thanks for having me today. I'm Denise Maccone. I am a account executive for the New Jersey area. I am with Angel Oak now 6 years. And I'm like a 25+ year veteran in the mortgage industry. So I've spent most of my time in wholesale, but I did spend a good portion of it in retail. So I have a very deep understanding of being a loan officer and what you deal with on a daily basis. And I think that helps me to be a better account executive because of that very, very deep understanding of what you go through every day.
And then Gary Martinek, our wonderful Maryland account executive.
Hey everybody, my name is Gary Martinek. I'm an account executive here in the Mid-Atlantic, primarily Maryland, but I do handle some Northern Virginia and all of Delaware as well. I've been here, I guess my resume is close to what Denise's is. I've been here, I think next month will be 9 years at Angel Oak, and I've been in the business, kind of hate to admit it, but about 31 years at this point. The majority of the time has been in either non-QM or subprime. Probably spent the first 8 to 10 years of my career in retail, kind of like Denise's experience, and then the rest of the time has been in wholesale. So kind of like you, I've been on both sides and know what a retail loan officer goes through on a daily basis. So yeah, that's it.
Awesome. And again, my name is Ben. I actually came from, I've been in kind of lending my whole career, but I actually came from the appraisal space for a long time, but I'm with Angel Oak for just about 6 years now myself. So welcome everybody. Before we get started, we're going to launch a quick poll. So this is always a great question that we always want to ask, is who has originated a DSCR loan in the past, right? Have you ever done one? It's always a great starting off point for everyone to think. You would think, I mean, DSCR loans are extremely popular. They're a huge part of what non-QM is, but there are a lot of loan officers out there that just have never done one. So obviously our goal is to, obviously educate you on this program, but also explain, why you should be extremely comfortable originating these loans. So hit that, definitely select that poll if you have or have not, and then we'll go ahead and get jumped in.
Wow.
It's actually higher than I expected.
Wow.
Oh, I can't see it. What did it end up being?
Yeah. I mean, more than half.
45% yes.
Okay,
great.
perfect.
This is great.
Awesome. That's fantastic.
Yeah.
For some reason, I couldn't see the poll. That's perfect. So again, but that's still just about half. So that's huge. So we're going to go ahead and jump into the program. I'm sure you guys don't want to hear us, talk about ourselves too much. A great jumping off point is our main website. Everything we do kind of launches off angeloakms.com. So whether it's DSCR loans or bank statement loans or really any other program, always a great place to start right here for resources and programs. But obviously today's topic is, where are you? There we go. It's the DSCR loan. Yeah, but and obviously we want to keep Gary, Denise, and everyone kind of going back and forth here. But Gary, do you want to go ahead and kind of give a brief, some of the touching points on the program real quick, and then we'll get into some of the deep dives.
Sure, yeah. So for those of you who have not done a DSCR loan is a debt service coverage ratio loan. It's strictly and only for investment properties. There is no debt ratio associated with the loan whatsoever. There's only one ratio that we look at, and that's the comparison of the gross market rent with the principal, interest, taxes, insurance, and any association fees that may be associated with the loan itself. So we're not looking at a debt ratio in a typical way. We're not worrying about how much additional debt they're carrying and so on and so forth. It's strictly based on the cash flow of the subject property. So without going into too much granular detail, I'll just hit some of the high points of the loan itself. Like for instance, loan amounts. Minimum loan amount is $100,000. Maximum loan amount is $3 million. And Denise and I will probably be talking about some exceptions that we will typically make along the way. And I'll just go off script a little bit and say, one thing we will never make an exception to is minimum loan amount. If it's $99.9, we're not going to make that exception. If it's $3.2 million loan, we want to have a conversation about that loan. That's a loan. That's something we will take a look at. So another thing to highlight here are all the enhancements that we make over time. It wasn't that long ago where we weren't going to $3 million. So that's a fairly decent sized loan amount for a debt service loan. We do all transaction types, purchase, rate and term, cash out. We do now, there's another enhancement, we do now allow short-term rentals, as well as using, and we'll get into this a little bit more as we go along, the way to calculate rent on a purchase transaction for a short-term rental. We can, in many cases, use a service called AirDNA. Debt service coverage, just to explain what that is for the folks who may not fully understand it. So a 1.0 debt service coverage is essentially the debt service, the gross market rent equaling the proposed housing payment for the subject property. So if my PITI association fees are $1,000 and my gross market rent comes in at $1,000, that's a 1.0 DSCR. So that's all that means. We do have no DSCR, meaning it can come below the 1.0 DSCR. We do have availability for that in a lot of cases.
Typically for like a vacant property or
vacant property or a long-term rental, and it's credit score driven as well. But no income, no employment. It's strictly based off of the cash flow from the subject property. I'll touch on one more thing here. Number of loans with Angel Oak, we allow a maximum of 5 or an aggregate of up to a total of $3 million. That is something also that we can play with here and there. If we have someone with 6 loans, 7 loans, we definitely want to have a conversation about that, or if it's more than $3 million. But on paper, that's the max that we will allow. And also one more point, and this is where this comes into play a lot, where agencies have restrictions on the number of finance properties that a client can have. There are no restrictions here. A client can hold, a borrower can hold up, 100 finance properties. We don't care. It's not going to be a great time for the loan officer to have to fill out that 1003, but we don't mind having that many finance properties. There's no limit to it. Did you want me to continue going?
No. I know you run into this a lot. The first-time home buyer and why, that's really kind of a little bit of a rub, right? But do you want to elaborate a little bit when that exception is,
so
where we fall on that?
Typically, this is a loan for an investor. So we want the borrower to have an established primary residence. And when I say an established primary residence, I'm saying that we would prefer them to own their own home, and then they can purchase investment properties with us. We're not requiring landlord experience, but they have to own a primary residence. However, there are some cases where you have a buyer who maybe has a great investment portfolio of properties, but is renting. I had a gentleman who lived in New York City, but he was renting there, but he had like 8 or 9 properties along the Jersey Shore. That were investment properties for him. That's a borrower that we would like to consider. But typically we want the borrower to own an established primary residence. We are going to be looking at the mortgage history, and that's what we want. So again, we don't require landlord experience, but you know, if we do have somebody who's renting, then in that case, landlord experience and them having multiple properties is what's going to set them apart and allow us to do that loan for them. I do want to point out that Gary did touch on the fact that one of the things that we do allow is that, you know, the borrower can have multiple finance properties or more than the 10 limit or whatever Fannie and Freddie are doing these days. But we always ask for reserves. On these loans, we always ask for about 6 months reserves. And in most cases, if you're doing a cash out, we'll allow that to satisfy the reserve. But in a purchase situation, the reserve is only for the subject property. And I want to point that out because we don't need reserves on all of the properties that the borrower owns. So I just wanted to point that out.
That's definitely important. Kind of with the first time home buyer, you know, a big point of that is, you know, a lot of people ask why. You know, a big reason is occupancy fraud. Right? We can't have one of these loans end up being a primary asset. That's something that you know, we're regulated by the CFPB just like everybody else. So that's absolutely, you know, if someone's renting and they're, you know, who buys their first house as an investment property? Not too many people. There are certain circumstances where that can be a thing, but you know, for this program, since it's no income, no employee, you know, it's a kind of a no doc, light doc kind of loan. That's really, you know, we have to be sure that this is truly an investment fund. So that's Gary. Do you have something you want to jump in there? Sorry, I think I stepped on you.
No, you didn't. I was going to say I think Denise and I had the same client because I had a client who rented in Manhattan for about $6,500 a month, but owned 3 rental properties in Baltimore City. Wanted to buy another one. They didn't own a primary residence, but we allowed that to go through because it just made sense. And those are the types of exceptions that we will look at in that case.
Right.
Yeah. And Denise, obviously New Jersey, huge for LLC vesting. Not that Maryland isn't, Gary, but we'll stick with the true Northeast here.
That's important. So yeah, we're gonna allow an LLC, and there's no restriction there. So we're not cutting the LTV back. We're not rate bumping you. We're allowing an LLC, but we've recently added that we'll also allow an S corp and a C corp. So and they also allow revocable trusts. So we've definitely expanded the product since just allowing an LLC.
Yeah,
and
if
go, Gary.
If I could, I'm not sure if Denise has this, but my own experience is that at least 50% of the loans that I do, at least under DSCR, are vesting or titling in an LLC.
Yeah.
So it's such common practice because of liability issues that this is a great thing to talk about with your referral partners that we allow this.
Right.
Yeah, and I mean, I'm north of Philadelphia, so we have transfer tax. So if you have a property in Philadelphia, to take it out of that LLC in order to do a cash out or whatever you're going to do, you're paying. So you know, it's extremely popular, especially where I'm located, just because of that, because that can be $2,000-$3,000 in additional fees, you know, for that borrower. So, you know, Gary, one thing I always want to clarify the LLC vesting is who's signing the note. And is it showing up on credit?
Yep. We're pulling credit. They have to sign a deed of trust, but the reason people do this is for liability, reduction of liability, because the only thing that's exposed in an LLC are the assets in that LLC. So that's definitely the draw for that. But you're right.
Yeah, it's a big one. A lot of people that, you know, they want to know, well, is this going to show up on my borrower's credit? Or, you know, and who's signing the note? We do require the borrower, they are personally obligated to this loan. When it's not since it's technically a business purpose loan, it's not a commercial loan. So, you know, we're not lending to an institution or an entity. We're lending to a person. So the title vesting, it's always good to clarify that. I always try to throw that out there because, you know, we'll always get questions like that on a day-to-day basis. But Dee, I was called Denise, in case everyone's on this and wondering. Interest only. What do you think your percentage of interest only is on these programs?
Yeah, I mean, interest only is a great addition to the product as well, because we're allowing the borrower to actually qualify off, we're calculating the DSCR on the interest only payment. So that actually makes a huge difference. So it's a 30-year fixed interest only. It's 10 years interest only, and then it's a 30-year fixed loan. So there's really no, I mean, other than a slight rate difference between a regular 30-year fixed and the interest only, there's most of them are closing under the interest only, and you can qualify off that payment. So it does help with the DSCR. And another thing to point out is that we're actually, I mean, we're going up, you could see on the screen that we're going up to 85 LTV. But we're also allowing actually gift funds on this. So as long as the borrower is 80 LTV or less and contributing at least 10% of their own funds plus the 6 months reserves, you're allowed to have a seller's concession up to 6%. And you're also allowed for an immediate family member to gift some funds toward the transaction. So that's a new addition that we added.
Yeah, the 6%, I think we added that.
We did. We increased it from 3. It used to be 3.
5 or 6 months ago. Yeah, and I think 3 was a little more industry standard, Gary. I'm not sure if you have some color on that, but the difference in the 6%, especially now,
Well, the addition of the two things, which I never thought we would allow, which is the 10% gift, which is amazing, and the upping the concessions from 3 to 6. That's really allowing a lot of borrowers to get into these properties a lot more easily.
Right. Absolutely.
Absolutely. Obviously a big question is always, condos, condo hotels, everything along that line. I mean, obviously we're in the Northeast. We don't see the Florida level. I'm sure there's a lot of people on this call that are in high,
You see a lot of people from the Northeast buying in Florida and looking at some of these condo towels. I mean, there is some new ones coming up all along the Jersey Shore. So, I mean, it's this whole area. But yeah, we're doing non-warrantable condos, warrantable condos, and condo hotels.
And Gary, if you want to touch on non-warrantable, just so everybody understands what we do versus what we don't on the warrantability.
Yeah, I mean, we're not going to allow excessive delinquency rates and so on and so forth, or any issues that have to do with deferred maintenance that involve safety. But for instance, one of the things that makes a condo non-warrantable is investor concentration. And as we were talking about some of the vacation areas, we allow up to 100% investor concentration, which is automatically non-warrantable, and that's something we'll do all day long.
But keep in mind, we don't want one entity to own more than 20% of the units. No. But we will allow, up to 100% of investors, which is great.
And let's while we're with you, let's talk about credit for a quick second. What we're looking for on the credit profile on a no doc loan.
All right, so we don't care about credit. No, I'm only kidding. All right, so 680 score. We're starting at a 680 score on this product. So keep in mind, we're not looking at income. We're not looking at employment on this loan. So credit is going to be a very big piece. So we're calculating on rent, and we're looking at the credit piece. We're looking at a minimum of a 680 score. The overall credit has to be good. We're focusing on the 24 months of mortgage history. So if the first, months 1 through 12 are clean, that's great. But months 13 through 24 could have up to 2 times 30. So that's great. If, say, for instance, your borrower has a 1 times 30 in the 12-month period, it doesn't disqualify him. We would just want months 13 to 24 to be perfectly clean. We also don't want to see more than maybe a couple of 30s on revolving and installment debt. So that's important. So overall credit, trade lines, at least 3 trade lines for 12 months, open and active, at least 2 for 24 months. And then, credit-wise, as far as like seasoning of like any type of default, foreclosures, deed in lieu, short sale, and anything, even 120-day late, we're going to look back 4 years on that. Now, this product goes up to 85, so we're going to look back 4 years. But if your LTV is 75 or less, we'll only need about a 3-year seasoning on that. So that's good to keep in mind.
Yeah, absolutely. And I guess the big thing, is and to everyone on this webinar, please, if you have these and this close, send it in. Send it in to your account executive.
Yeah.
You'll have an account executive. We'll absolutely, we'll absolutely get you in front of the right person. But we can have lead up time also. So if you're getting close to that mark, send it in. That's something that we can always, we can shave a little time off here or there.
Something out of character for the borrower, and it's a little bit more out of our guideline here. It's a one-time event. Something must have happened. We want to take a look at that for you.
Absolutely. But obviously, talking about this program in general, we can't talk about it without market rent. So, the 1007, Denise, do you want to kind of cover just, again, 1,000-foot view, because we don't have a 1007 really to pull up. That actually would have been a good idea. But let's talk about the 1007 and what we're looking for.
All right. So basically, a borrower is purchasing a property. The appraiser is going to go out and he's going to deliver us market rent for the property based on like a 12-month rental. And we're going to use that rent. We're going to use that rent actually at 100%. We're not taking a haircut off that for expenses. So we're using 100% of the market rent. And in that case, the borrower, whatever the pity payment you're asking for, we calculate the DSCR. So we have, as long as the pity payment is covered by the gross market rent, you're good to go. That's a one debt service, one and higher. In some cases, maybe the rent comes in a little bit lower, and we do have a debt service option that goes from like 0.80 all the way up to 0.99. And then we also have a no debt service option as well. That's for, sometimes, condos and stuff with HOA fees, and, they kind of can get a little out of whack, and we can go a little bit lower. Again, you're going to see a lower LTV on that. You're going to see a little bit different in rate. But as far as market rent goes, on a refinance, we're going to be looking at the market rent again. So the borrower says, oh, but you know what, I'm getting a little bit more than market rent. So the appraiser says, I'm getting, market rent is $2,400, and the buyer, the landlord says, no, I'm getting a little bit more. My apartment is furnished, or I allow pets, and then he's getting more market rent. Well, we will allow him to prove that to us. So if he gives us a lease and he gives us at least 3 months of payments that he's received at the higher market rent, we'll actually, if it's within reason, we're going to accept that. So as long as the buyer or the landlord or the borrower is receiving that rent, we're going to definitely consider it. So always market rent, and then path of least resistance. And then if they have to prove that they're making a little bit more money, we allow them to do that. So we don't want to get into leases. We don't want to get into all of that unless the borrower wants to tell us it's more.
Yeah, overruling an appraiser. I'm sure everyone on this webinar has had an appraisal just tank on them. Not in value. I'm sure we've all had one of those. But all of a sudden, value came in perfect, and on the market rent, you're like, whoa, what the heck just happened? So yeah, on those refis, being able to overrule that appraiser, just saying, well, no, this is what I actually get, and we absolutely will base that DSCR off that. So it's one of those times where it can help save the deal for sure. And I always like to emphasize that no DSCR. That's actually one of those things that kind of sets us apart as far as non-QM lenders. We're only a handful of us out there that actually offer a true no DSCR ratio. That's if they completely tank it out, or if you're we're in a high sales price kind of environment, and all of a sudden maybe that market rent comes a little lower, and now you're at a 0.75, 0.79. We still have a solution for you. So
right.
If you guys get into those scenarios,
even for a refinance, where he's got a tenant moving in, a tenant moving out, and they're at the time of the appraisal, it is vacant. We can now look at it under that no debt service program.
Absolutely. Well, we definitely want to come to short-term rental and AirDNA, guys, because that's that's absolutely something that I'm sure, I mean, we have people from all over the country on this webinar. Obviously, where we are, we have the Jersey Shore, the shore points of Maryland, Delaware, the Outer Banks, North Carolina, and Myrtle. So, that's sort of right in our wheelhouse. So, Gary, if you want to just talk about, air DNA and those requirements, I'll pull up.
Yeah.
Actually, I already pulled up.
So for purchases of short-term rentals, we will accept Air DNA. For those of you that don't know what Air DNA is, it's a model that was put together by Airbnb to project rental income for short-term rentals. So as long as certain metrics hit, we could use this in lieu of an appraisal, actually, or the rent schedule, I would say, for this type of property. So in order to do that, we have to have a couple of things hit. And you can see Ben is on the website right now, where we can pull up a property to show what we're actually looking for. And we're looking for a couple of things, a few things. One, a 65% occupancy and a confidence rating of 70%. So when you can get yourself an account very easily going on to AirDNA and just getting a login and password and pull up any potential property in the country. So you can see what Ben has pulled up right now for a particular property here with a 72% occupancy rate that hits, right? So that's over 65. And
market score not so much.
Say again?
Yeah, the market score not so much. I just pulled this up randomly.
Yeah.
But important thing to mention. Yeah, important thing to mention, Gary, is we will actually do this for you. So, yeah. I mean, to log in, you don't actually have to pay for AirDNA. Like, there's actually a subscription thing that you can do, but you can actually do the free. This is a free model. Like, I don't pay for this. So this is, you can just log in and we'll know, obviously if the market score and the occupancy rate works, we'll know before you even order we will know at pre-qual stage if your market rent will work for AirDNA program. So keep going, Gary. Sorry, just jump in there.
No, that was it. I was going to say, like, you can always check very easily without a subscription if before that even comes in the door to see if the numbers are actually going to hit and we can move forward without actually ordering an appraisal on this. So very simple. We just started allowing this on short-term rentals. And obviously certain parts of the country, this works a heck of a lot better than in other parts of the country, obviously, for an occupancy standpoint. Southern markets and West Coast markets are going to hit that 65% a lot more easily than, say, if you're trying to get a short-term rental in Boston or something like that. It may not be occupied 65% of the time of the year. But this is definitely another tool to use for short-term rentals.
Clarify one thing: we still do need an appraisal.
Yeah.
I think you misspoke there, Gary. But this will overrule the market rent analysis. And Gary, I'll jump in one more thing. A big difference, because there are other providers that allow AirDNA. We actually take 100% of the projected revenue. So that's kind of important. Like, so the operating expenses coming out of the net operating income, like we don't take these numbers into consideration. We're looking at just what is the projected revenue of this property. So there's no haircut on that number, which I think, and everyone on this call, don't quote me too hard. I don't want to get any nasty grams after this saying, well, someone else does it. I think we're one of the only ones that actually give 100% of the projected revenue. I'm not sure if you guys have seen anything to the contrary, but
to my knowledge, I think that's true.
Yeah, that's one of the differentiators for us. Is we'll give you 100%. So you just take that 42,000, you divide that by 12. That's going to give you your monthly market rent, and then slap that against your PITI, and that's your DSCR. So pretty easy, especially something you can do. We'll do for you at pre-qual stage. So it's handy going into something knowing that outside of the regular valuation, obviously value counts, but not too many things are under appraising these days. Being able to know what that market rent is going to be before you even order that appraisal is pretty huge. Gary, real quick, I mean, for refis, for properties that are listed Airbnb, do you want to cover that real quick? Because I'm sure that might come up too.
Sure, we can get printouts for refis, so they're actually actively renting through VRBO or Airbnb. You can get printouts that will show the last 12 months rental history from those properties, and that will be acceptable as well. For new rental properties, for new short-term rentals, it's going to be for purchase only. But for existing VRBO and Airbnb, we can use the actual rent that's been received.
Yeah, the only caveat, we just need 12 months of it. So we need
Yes.
a 1-year look back. So if you have a refi that's been listed Airbnb or VRBO, if they've been running it for a year, we can absolutely use those to basically back create a revenue stream. So perfect. I mean, that's kind of AirDNA. Do you guys have anything else you wanted to bring up on the short term piece before we kind of keep
That's becoming just,
yeah, I mean, the appraiser
anecdotally.
sometimes can do it. They can give you can coach the appraiser to give you a short-term rental, but some of them push back on that for some reason. It's kind of strange. So this is actually a great tool because, if you have an appraiser that goes, didn't we recently have somebody, one of the companies was like, we're not going to, give short-term rentals anymore. I mean, these investment
I can actually
short-term rentals, you can rent a house out for 3 months in the summer and it pays for itself, it's just
well, there have been some articles that have been coming out lately, and this is just off topic a little bit, where resort areas like Ocean City and other areas, hotels are now starting to feel a measurable impact from folks renting out condos and short-term rentals. They're seeing a 3 to 4% decrease in revenues because of the prevalence now of these short-term rental properties in those areas. So it's becoming a bigger piece of the equation as time goes on.
And the tax revenue. But I mean, I can speak to the kind of the industry piece and the appraisal world. There's a lot of stuff going on right now with whether short-term rentals should be used on a 1007 market rent analysis form. There's a lot of opinions, as we're in the mortgage business. There's a million opinions on everything. But right now, there's a lot of talk about, that this isn't the right form, the right appraiser, the difference, between a certified residential and a certified general appraiser who should be doing this. This is business purpose. Should a certified residential appraiser actually even be doing this kind of work? So, there's a lot of that kind of going on in the background right now. Some AMCs are starting to push back for short-term rental. We can't ever demand an appraiser use short-term rental. Some certainly do, especially in areas where it's clearly a short-term rental area, right? If you're in Myrtle Beach, you're going to get short-term rental counts. But this is a great tool to be able to sidestep all of that noise. That, and obviously if it's a refi, being able to have that rent roll, all of that kind of just goes by the wayside. So, for that perspective, it's actually kind of nice that knowing that you don't have to kind of hold your breath waiting for that appraisal. That's something that I think we've all done too many times. There's probably going to be a lot more to come from that. Anyone who follows the appraisal industry, which you have to be a glutton for punishment for that, but it's definitely an important piece of our business. I'm sure there'll be more to be said. But yeah, that's, again, we're a little off topic there, but not really. We were talking about valuation and market rent. So, cool. Yeah, I mean, that's kind of the broad strokes, but a big thing for Angel Oak is, how to partner with us, how to look stuff up, what kind of support we give, like that whole piece of it. So Denise, I mean, we want to show everybody quick quote and quick log. We want to show people marketing and show how to go find these customers. Do you want to just take us through quick quote real quick and just the benefits of it and that whole thing?
So working with us, you have the benefit of what is basically a live pricing engine and scenario tool. So you're going to go to our website, angeloakms.com. And the first thing you can do is you're going to click on the icon for non-QM quick quote. This section of our website is not only going to price a loan for you and see whether a scenario works, but it's also going to give you the next steps to send the loan for pre-qual. So you can price at any time. If you like what you see, you're going to proceed to the next steps. So let's just get some kind of scenario in here. And what's great about this tool is you can keep flipping it around. Let me see if they put another 5% down. Let me see if they, and you get better pricing each time. So right now Ben's putting in a scenario. I hope it doesn't make me look bad. But let's see what he comes up with. Yeah, you're gonna price out 85 LTV multifamily. No, what do we got here?
No, I just what do we 75.
No, yeah, this is perfect. Doing something that we see all the time. 75 LTV is a typical LTV bucket for us. Let me see the score. Typically these buyers have a good credit score. He put 800, but anything. I mean, most of the time they have great credit, and they're looking to buy a few properties here. So here's a typical good credit, one debt service. Yeah, I mean, what are you at 760 right now? Okay, so
yeah, there's no difference between 760 and 800 for us guys. For everyone watching, it's the exact same thing. We our top bucket 760. So.
Yeah, perfect scenario. Guy wants to buy a property in Maryland. It's a single family. It's an investor. Maryland does allow a prepayment penalty, so you can play around with that, which is great because that can deliver better pricing because it eliminates some risk for us. And there you have it. Basically, this is telling you, Ben.
Sorry, I was showing the discount for 4 years.
I gotcha. So this is basically telling you that you have 75 LTV is what you requested, but it's letting you know that technically this can go up to 85 LTV, which is great. Your rate is 6.7. Yes, your rate is 6.75 right now. It's a 30-year fixed rate. Can't beat that. Again, we're looking at 48 months bankruptcy seasoning and housing event, but technically, because it's 75 LTV or less, we can actually look back 3 years on that. So we're looking for 6 months reserves, and this is based on a 30-day lock. So Ben, can you click on view rates for me? This is where you're going to pull up the rate stack.
And you can also always price in LPC. So
yeah,
par paid is one
thing. For now. Yeah, just for now, for argument's sake. So we come here, and the first thing we want to do is we want to find our par rate. So closest to par is 6.75. So that's what we have. But your borrower is actually getting an eighth of a lender credit here, which basically pays for their appraisal or part of it. So that's actually great. And then you have the full rate stack here. If you did want to increase the loan, the interest rate for some premium lender paid pricing, you can do that as well. So it really depends on the state. It depends on the prepayment penalty that you're taking, of how much comp we can allow you to build into the interest rate. All right, so if you liked what you see here, and again, this is going to kind of shut you down if you're asking for things that we don't offer, and it might say, see account executive, or speak to your account executive. Anytime, that's when you're going to pick up the phone and say, hey, what did I do wrong? It could be something you clicked on wrong here. It could just be a glitch that day, but always run it. If it says, something's not available, run it by your account executive. And then I want you to click on select option. So when you click on select option, this is going to take you to the fields that are going to allow you to submit this loan for pre-qual. And very simply, that first you could upload a 3.4 file. We don't necessarily require it. In fact, probably just continue. You're going to fill out this form, which is just really your basic loan officer information. Select your account executive. And you're going to now upload a PDF of your application plus the lender information page. And that's very important because with the new 1003s that we're looking at, the taxes and insurance don't show up on the actual body of the 1003. We need that lender information page to get the details on the taxes, insurance, and any HOA fees. So that's going to help us with our DSCR. And then you're going to drag and drop PDF of the credit report in there. And that's it. And your application itself does not have any employment and does not have any income on it. But we want the rest of it complete. So you're going to send a complete application with that one section you're going to leave blank, which is the employment and the income. And then once you fill it out, you'll answer a couple of questions here at the bottom. You hit submit. Keep in mind, this is the most secure way to get this information to your account executive without jeopardizing security for your borrower. So, yeah, you don't want to email to an account executive without them sending you some sort of a secure feature. But this is secure. So this is the best way. You can put your additional comments there, whatever you need to let us know about the deal, and you hit submit. Very simple.
Absolutely. And, I'll add one thing on the qualifying. When you selected that rate, some people think that that's a quasi lock. That's actually just the qualifying rate. It gives us an idea of what rate you and your borrower are looking for, because that rate's obviously going to impact the DSCR, right? That rate moves, that DSCR is going to move. So, we want to kind of know where you want to be in there. So that's the only reason why we actually have you select a rate in the quick qual process. It's just so we understand because on our quick qual side, and we don't have a sample quick qual for everybody, but we'll actually have that qualifying rate. We'll actually have those ratios and all that built in. So you'll see, like, okay, based on what you told us, it's not a lock, so this isn't set in stone, but based on basically what you're looking for, this is where we're looking at. Gary, did you have anything else you want to throw on here, bud?
No. I mean, I think, Denise touched on everything. And I think, what she mentioned about the 1003 is very important too. Just make sure on the 1003, we're not looking at any employment, any income. Make sure the rest of it's complete. Schedule of real estate's filled out, associated liabilities. We do need to see that. We do need a history for any other liens that they have on any additional properties, just to complete 1003, just minus the income and employment. We never want to see that on a DSCR loan. So I think other than that, I think it was right. That was complete.
Yeah, the REO section is huge. I mean, we're really looking, like as Denise mentioned, the credit. We're really looking at this borrower's mortgage history. That's huge. So we're basing the ability to repay of this loan based on its own cash flow, but the credit profile for the borrower is gigantic. So how they pay their mortgages, the properties they own, that's going to weigh in a lot. And the more accurate of the 1003 you have, the better for us, right? We're going to be able to see the picture a little bit better, especially if we need exceptions. And Gary, we'll jump into the marketing world here, but Gary, do you want to touch on exceptions? I mean, I just brought it up, so might as well keep going with it.
Yeah, I mean,
how big they are.
So one of the nice things about working with Angel Oak is that we do have an actual exception process. And this is the part of the process where we take care of that if we know one is needed, which is at the quick qual stage. So from this point, if we do need an exception made, and we'll go over different types of exceptions, like for instance, Denise touched on, credit and mortgage history, 1 times 30 last 12, 1 to 12 months, or 1 times 30 last 12 months, 2 times 30 months, 13 to 24. If we're off of that and we have like an additional delinquency, that's something that we can take a look at. And it's from this point that we would send this file to review upfront. And we would get whatever we needed cleared up front if it's an exception that's allowable and that's doable. So we do make exceptions for different things like credit history, mortgage history, that type of thing. And this is where we would address those types of things.
I mean,
one of the things we talked about before, which is if someone doesn't own a primary residence, but the loan makes sense, if we needed to send something like that to risk, we would do that from this point as well. I'm sorry, Denise, I think I cut you off.
No, I interrupted you. I was saying that, Ben, you were pointing out that there's a certain percentage of our pipeline in general that closes with exceptions. I mean, just at Angel Oak in general.
I think it's like, upwards of like 20 to 25%, if I'm not mistaken.
I think it's up to almost 30% right now. So,
yeah.
We know that even though we're out of the box, there's even a little further out of the box that will run across. So.
Right.
Denise,
and having an upfront underwriter that, and documents the file, you want to make sure that that's taken care of before you're putting the borrower out for appraisal. These appraisals aren't cheap, especially for multifamilies, which is mostly what we're doing under this product.
So Denise brought up like trade line requirements, 3 for 12 months, open for 12 months with activity, or 2 for 24 months with activity. For a few months off here and there, those are the types of exceptions that we want to take a look at, right? So I guess the theme is, if it's in the ballpark, we want to have a conversation about this. There may be an opportunity to get an exception made and get this loan through. We do it all the time, all the time.
So, and I think, I mean, I know we did some internal, kind of review. I mean, obviously we do our internal reviews on exception. I think reserves was our number one exception, I think. So again, guys, we just require reserves on our, on our subject property alone. There are people out there that require them on, 3 months for other REO and, all that stuff. If you're shy a couple months, please don't not send that loan because of that, right? If it's a good loan, if it's a solid borrower, we're not going to turn that loan down because they have 4 months worth of reserves and not 6. That's, we don't want someone spending every dollar they have, we're going to want some reserves, but okay.
If I could, also, I'm not sure if Denise touched on it, and if I missed it, I apologize, where if it's a cash out refinance, the cash out can be used to satisfy the reserve requirements if it's cash in hand. And there were a couple of other things I wanted to bring up because I know we're getting closer into the hour here. And this is completely off topic, but 2 different types of transactions, which is, we do allow delayed financing up to 6 months. So if somebody has to purchase a home for cash or even with hard money, and they've owned it for 6 months or less, we could treat that loan as delayed financing and price it and underwrite it as if it were a purchase to get their cash back out of the property since they had to move so quickly on it. We'll use the acquisition cost in order to determine LTV. After 6 months, we can treat it as a cash out refinance, underwrite it, price it as a cash out, and use appraised value at that point. I just wanted to touch on those couple of things before we got into the next section.
And also 30 days asset seasoning. That's another big point.
Yeah.
We're all used to, Fannie, Freddie, 60 days asset. These are 30-day asset seasoning. So that's another perk. All of Angel Oak, that's all of our products actually, except for what we want to touch on next, which I would think is going to be the foreign national, right?
Yeah,
segue right into that.
That was good. A big thing about this.
Yeah, go ahead. What were you saying?
A huge part about this program is the speed also. The delayed financing, I know everyone on this call has realtors and you guys probably have borrowers that have to have a cash option, in investment properties. And they're going to come in with cash because cash is king and people are going to accept their offer. But no one really wants to tie that much cash into a property. They want to get their cash back, go do it again. They want to buy the next property and the next property. So the delayed financing is a huge tool. But the big thing is the speed of this program. This product does fall outside of TRID. So we don't have a clock on the back end of this thing. It is extremely, if you're doing a cash out, you're a driver's license and mortgage history. You don't need assets. You don't need income. You don't need employment. We may need a couple of LOXs if there's something in credit that, we want a little explanation on. But outside of that, it's pretty fast because there's not a lot to these loans. It's a credit profile and collateral. That is it. So, when you think about everyone, as you're doing loans, as you go, like just imagine cutting out all of the income, employment, tax returns, you cut all that out. What are you left with? It's credit and collateral. That is it. So that's the kind of the fun part of this one is how fast you can get these. I think our average turn time on these are 12 to 15 days. We're closing loans at 9 days. We accept appraisal transfers too. So you can transfer an appraisal to us also. So even, so if you guys have fallout from anywhere else, please let us get a look at them and we can see how fast we can get it done. But Denise actually did an awesome segue right to our foreign national. Obviously, we have people from all over the country on this call. We'll just touch on this briefly, guys. We're not going to go too crazy into this, but the foreign national piece.
It's not. You're looking a true foreign national, somebody who lives and works outside of the United States and wants to purchase property here in the States or refinance something that they already own. As long as they have a true foreign national visa, and the visa types are right there up on our website. You speak to the borrower, they live and work outside of the United States, they have one of these visa types. We're going to entertain this loan up to 70 LTV on a purchase, and we're going to do 65 LTV on a cash out refinance. We're lending them, we're a little bit more limited, obviously for risk, because we're not actually running credit for a foreign national. In the past, it was a convoluted process where we had to get kind of foreign credit letters and kind of translated documents, and we're not looking for that anymore. So we're pricing, we're keeping the LTV where we're protecting ourselves risk-wise. We're not running credit, but we're also requiring the funds we're going to be looking back 60 days on those funds, and 30 days of it has to be in a U.S. account. Again, it's a foreign national visa. This country cannot be on any type of sanction list or anything like that. So we're going to be keeping them at 70 LTV, 65 on a cash out refinance, and a 1 DSCR. So they don't have any other options like the 0.80 or the no debt service program. They also are going to require, instead of 6 months reserves, we're going to be looking for 12 months reserves. Now, those reserves can stay in their country. That doesn't have to be in a U.S. account, but we're going to require them to have at least 12 months reserves, and we don't allow gifts. So these are true investors from another country with a proper visa that we're going to allow to purchase some property here, and we treat them all as investors, and we do them all under this debt service program. I think that's it. It's a very streamlined loan, so if you do get an opportunity to, speak to somebody who can give you these type of referrals, I mean, they move relatively quick. There's only one thing that we do require, and I want to point out that we actually want them to have an automatic payment. So that's a requirement, and that's like a hard stop, because in the past it was very difficult, because you're basically mailing out to a foreign country and whatnot, so that's got to be direct payments right out of their checking account. That's it.
And I'm sorry. There's some questions in here, guys, but I can't open them.
If I could just say one thing too. One addition to this, there are certain countries, there aren't too many moving parts to DSCR, and there are fewer moving parts to foreign national, because you don't even have to have any credit or employment or income. But there are certain countries like Canada and countries within the UK, they're part of the visa waiver program, so you don't need a visa actually for those countries. You just need to have a valid passport. So if anybody from Canada or the UK that's looking to buy investment properties, they just need a passport.
Sorry, guys, I can't open the chat window. So we have another one of our fantastic regional managers manning the chat group, guys. I apologize. I can't ask too many of those questions right now. I think we covered some of them. I can see a tiny little window box. So I wasn't going to get out of this with some kind of technological issue, guys. I'm sorry. But yeah, that's foreign national. I mean, it's, again, falling under our DSCR program, extremely easy, extremely fast. It's got a couple of those overlays. And if you don't see your borrower's eligible visa here, definitely send it to us and we can get a look at it. It can't be a student visa. It can't be a work visa. Obviously, they can't live or work in the United States, so those don't work. But, if there's something in here that you have a question on, please feel free to, send it in. Right? There's no such thing as a dumb question. So we want to see them. But guys, we're running a little long time. But Gary, we're going to jump into our TPO.
Okay.
Into our TPO portal. I think it's this one.
So where Ben is going, he's going to go to our TPO portal, into our marketing collateral that's available to you. So.
Yeah, and guys, we use TPO. I mean, we use Encompass. So for all of you out there, about 80% of you probably use Encompass traditionally. So our entire system is Encompass based. So you're going to probably notice a lot of similar looking things here. But we want to take you through our marketing portal. We want to show you where you can go, help you market these programs. And again, it's not just DSCR loans, it's bank statement, it's asset qualifier, and agency and full prime jumbo fallout, things like that. So we have a lot of cool products, especially our brand new bank statement HELOC with an optional appraisal waiver that you guys definitely want to take a look at. But sorry, Gary, keep going.
No, I was going to say, so we have a lot of collateral available to you out there that says absolutely nothing about Angel Oak whatsoever. It's there for your use to market to your referral partners, the majority of which are going to be real estate agents. But Ben, if you want to highlight, like if you want to go down real quick to where the flyer section is. So once you get your Encompass logins, your login credentials from Angel Oak, you'll automatically have your contact information available. So if you want to pull up and we have Spanish flyers as well, but we have flyers for all of our programs. So if you want to find where the DSCR flyer is, investor cash flow is what we call our DSCR. So as you can see, Ben's already customized it for himself. But these flyers are for your use to market these programs. You can pull in your photograph, you can pull in your company logo, and you can pull in all of your contact information in just a couple of minutes and send these to your referral partners. Use these to market to your referral partners to bring in more of this business. One thing I do know, like having done a lot of lunch and learns, and most of the lunch and learns I do with retail loan officers are with real estate agents. And I do know two things. One, most real estate agents are investors and they're all self-employed. Okay. So these programs resonate with them and very few actually know about them at all. So once you start knocking on their doors and saying, hey, we've got this program, you can have an unlimited number of finance properties. It doesn't require any income or employment to be shown. It takes 2.5 weeks to close these loans. There aren't too many moving parts. The pricing is excellent, and you can use these materials in order to market. You'll start getting some traction with your referral partners with these programs, and it's all here available to you as soon as you get credentials.
I didn't put my photo up here, guys, but yeah, you can put your photo and logos and all that stuff. I didn't do any of that, so I apologize.
Right. Well, you don't want your photo, that's for sure. But
see my face now.
We also have, so all these flyers are available to you. Can you go back to the okay? So one of the things we do have social media posts and we have presentations. So we have all these social media posts that you can take and use for yourself. Once again, doesn't say anything at all about Angel Oak, but you can use these to market yourself on LinkedIn and all of your social media as well. And they're all available to you, already done.
Yeah, keep going.
We have a good presentation on. Go ahead, I'm sorry, Ben.
No. And you can keep scrolling. We have enough content on here. Our marketing team does a great job of doing all delabeled stuff for you guys. So take advantage of that.
We also have an actual PowerPoint presentation called the Realtors Untapped Market, which you can put your contact information on. It's a PowerPoint presentation, goes slide by slide, covers all the different facets of not only what we offer, but the non-QM market as well, to let if you get a lunch and learn or a presentation to a group, this is great. It's already a canned presentation. You don't have to reinvent the wheel. It's there for your use.
Yeah, and actually a cool flyer for
market
that event also. Yeah. And again, this is all customizable stuff, guys. So you can go in there and chop it up and you can, do really whatever you want. Our real big role here is to help you go out and get more business. So anything we can do, obviously, to help that, we will. We're right in an hour, guys. Oh, keep going, Dave. Sorry.
No, any questions that they're gonna send to us? Is that what's gonna happen? Because you said you had questions in there you can't read.
Yeah, guys. Any of the questions, I think Mo, our inside regional manager, has been answering them. He's been firing away as usual, I'm sure. But any questions, we're going to get you in touch with your local account executive also. If you don't know who your local or your dedicated point of contact is, please send anyone in our company a message, and we'll absolutely get you introduced to them. And any questions that haven't been answered, we'll absolutely get answers to you here shortly today. But I want to thank, obviously, Denise, Gary. Thank you for doing this with me. Not too often I get to host these, so hopefully this was helpful for everybody. But with everyone traveling for conferences and stuff, I got the chance to step up and do one, so it's fun. But thank you everyone for joining and attending and listening. Again, Angel Oak, we're the largest originator of non-QM in the country, so anything we can do to help you, please don't hesitate to get in touch with us.
Thank you.
Thanks, everybody.
All right, guys. Take care.
See you guys.
See you later.